Okay, and we are going to look at chapter 12 first, dealing with the reports. So we've gone through all of our discussion of all the evidence, etc., procedures, work with internal controls. They're going to lead up to our report on the financial statements. Okay, and then we'll talk about other types of engagements that go beyond just audits of financial statements, mainly compilation. Really? Can you guys open it? Why does it do this to me? Okay, I never understand that. I don't get it. Okay, but fortunately I have it here. Okay. Okay, and let's go ahead and take a look at the audit reports forming an opinion. Okay, and when we form an opinion on the financial statements, we are really wanting to determine whether or not the financial statements were prepared in accordance with generally accepted accounting principles. Now, when we look at this, we're going to be looking to see if we were able to perform adequate audit procedures to then determine if the financial statements were prepared in accordance with the generally accepted accounting principles. Okay. Now, when we're talking about financial statements, we are talking about, and we'll see that the report will talk about applicable framework. Applicable framework is generally U.S. Gaap. Okay. And complete set of financial statements, as you well know, is going to be our balance sheet, our income statement. We could do a combined statement of comprehensive income and income statement, or we could have a separate statement of comprehensive income, statement of cash flows, and the notes there too. So when we write our opinion, it covers all of that, right? Including the notes. Okay, sometimes I think we forget that the notes are considered an integral part of the financial statements. Okay, now I call this slide the grapefruit, okay, because it looks like one of those, yellow grapefruit, pink grapefruit, etc. I don't know if you have any green grapefruits, okay, but what happens? You take a look, and we could have an unmodified / unqualified opinion. Okay, now this is good. Okay, let's put a face in there that emphasizes the feeling of the auditor. When we have an unmodified, unqualified opinion, this is a good thing. Okay, now sometimes students get confused because they think of unqualified as what? As a bad thing, like when you get a letter that says, sorry, you're unqualified for the job, right? Unqualified means good, means we think that financial statements are free of material misstatement. Now you say, well, unqualified, unmodified, what's the difference there? Unmodified is what we mean for a clean, good opinion, happy opinion for a non-public company. Unqualified is the term that we use for public companies. And we're going to talk about both versions of the reports. Oh, by the way, only eligible for the extra credit if you're here today. Okay, so people that are just missing class habitually, I'm not letting you do the extra credit. Okay, so you might want to communicate that to somebody that you know. No extra credit for people that are just, are always missing class or walking out in the middle of class and stuff. Okay, so we have what? We have unmodified, unqualified. These are good. Unmodified is for what? For non-public. Unqualified is the term for public. Okay, now what happens? We can start to have some things that go wrong, okay? The company doesn't fully follow the generally accepted accounting principles. If that's the case, then the auditor starts to be sad, okay? So the auditor will say, in our opinion, the financial statements are fairly stated, except for, and we'll call out some something related to generally accepted accounting principles that the entity did not follow. We're required to call that out in our report. We call that a qualified report. Okay? For example, let's say you have a buddy, and your buddy says, hey, I have a job interview tomorrow, and I want you to come and look at my outfit for my job interview tomorrow, see if you think it's appropriate. So your buddy comes out, perfect suit, shirt, tie, shoes, everything is perfect. You sit there and you say, unmodified, unqualified opinion, you look good. You should get the job just based on how you're dressed. That's the unqualified situation, right? Now let's say your buddy comes out, and your buddy comes out in the suit and everything, but when you get down to the shoes, he's wearing a pair of Air Jordans. Okay, nice shoes, but not appropriate for an interview, right? So you say, hey, what shoes are you going to wear tomorrow? I said, I'm going to wear these. I want to show how energetic I am, that I can really jump high if they need me to. You say, no. Your outfit looks good, except for the shoes. Well, this is what we're doing with a qualified opinion. We're going to say the financial statements are fairly stated, except for, and we'll call out what's wrong. Now, are shoes material to an outfit? Yes. Are shoes material to an outfit? Yeah, some people say they're the most important part of an outfit, right? So they are material to the outfit. So we're going to say something's wrong with this outfit. I'm just looking at my shoes now. I feel like, look at your shoes, but okay, we're going to say except for the shoes, right? Okay, good. Now, we go down, and when we have issues related to the financial statements, there's some aspect of Gaap we didn't follow. And so the auditor is sad. What are these? These are tears. The auditor is now what? The auditor is now crying. The financial statements are so misstated that they're saying, hey, you cannot rely on these financial statements. There's some things that are very, very wrong with these. Okay? So let's go back to your buddy. Your buddy comes and says, hey, I want you to come look at my outfit for my suit for my job interview tomorrow. Your buddy walks out in a full sweat outfit. Very nice, cool looking sweatsuit, running suit, but no. You're not going to wear that to the interview tomorrow, and you say, oh yeah, I'm going to wear this because I want to show how flexible and energetic I am or something. You say, if you wear that outfit tomorrow, they're going to call security on you, right? So now you're saying, no way, that is not adequate, right? Okay, so we have gone from what? From bad to worse. And it's a matter of degree. It's what? It's how material and how pervasive, how extensive that misstatement is that caused us to go from qualified to adverse. Now, there's no listing of things that are bad enough to put us to qualified or adverse. It's auditor judgment as to whether you're going to go from a qualified to adverse. Okay? But when we're over here, it's Gaap problems on this side of the chart. Gaap problems. G-A-P-P, generally accepted accounting principle problems. Okay? Now, this chart goes one way or the other. It doesn't go both ways. You're either on this side of the chart or on this side of the chart when we start getting into the pink and yellow grapefruit part, right? Okay? So what happens? On this side, we're going to have GA, generally accepted auditing. We're going to have gas problems. Okay, go ahead and laugh if you want to. Okay, now we're having gas problems on this side. So what happens here? Now there was some generally accepted accounting principle that we couldn't follow, that if we had been able to follow it, we might have determined that we want to qualify or adverse our opinion because we weren't complying with Gaap. So we weren't able to complete some audit procedure. For example, we wanted to confirm accounts receivable. For some reason, we couldn't. So we'll say our opinion is, we don't say that, but we would be meaning our opinion is unmodified and qualified, except for, and we'll qualify, we weren't able to confirm the accounts receivable, whatever it was. Okay? So go back to your buddy. Your buddy says, come look at my outfit. You come, and when he comes out, He's not wearing shoes. Nice socks, no shoes. And you say, well, what shoes are you going to wear tomorrow? And he says, well, I'm going to pick up some shoes on the way to the job interview. They're going to be nice shoes. Don't worry about it. Okay, well, you say, okay, my opinion about your outfit is what? Good, except for what I would have been able to tell you about the shoes had I been able to see the shoes that day. I wasn't able to audit the shoes. I wasn't able to look at the shoes because you didn't have them that day for me. So what am I going to do? I'm going to qualify my opinion because I couldn't apply some audit procedure that I would have liked to. Seeing the shoes. Okay? Now, notice that if my gas problems go from bad to worse, they go to more pervasive. Oh, so the auditor is sad here. Got to keep the face thing up. Auditor is sad because there was some procedure I couldn't apply. When I go to disclaimer, now I'm not going to put a mouth on this auditor. I'll still give him a nose. No mouth on this auditor. Because this auditor is not saying anything. You see the shoulders? This auditor is shrugging his shoulders, or shoulders, whatever, saying, I don't know if the financial statements are fairly stated. There were so many things that I wasn't able to do as part of my audit procedures on this that I'm throwing up my hands, whatever, my shoulders, I'm shrugging my shoulders saying, I don't have an opinion. Okay? For example, your buddy calls you up, says, I want you to tell me what you think of my outfit for my job interview tomorrow. You say, okay, I'll be right there. No. Don't come over. Just tell me, by the sound of my voice, how does my outfit look? And you're like, I can't tell you what your outfit looks like by the sound of your voice, right? So you've disclaimed an opinion, haven't you? Okay, so if there's so many audit procedures that you can't perform, you give up and you say, I don't have an opinion. I disclaim an opinion. I do not have an opinion on these financial statements. Now, it's a very pervasive problem that will cause this. Now, generally, you don't see a lot of disclaimer of opinion in practice with companies because if the company got a disclaimer of opinion, they wouldn't even be able to be listed on the stock exchanges, etc. No one's going to give them a loan, etc., right? So you don't see it that much in a situation with a private sector entity. You do see it with public sector entity, and particularly, I'm talking about the consolidated financial statements of the federal government. Each year, your federal government gets a disclaimer on their financial statements. Now, why do they get a disclaimer on the financial statements? Well, there's a couple of reasons. One is nobody can audit Department of Defense. And if you're not able to audit a major subsidiary of an entity, in which the consolidated financial statements of the federal government, Department of Defense would be like a major subsidiary. If you can't get an opinion on a major subsidiary of a consolidated set of financial statements, that bubbles up into a disclaimer on the consolidation. Now, why can't we get an opinion on Department of Defense financial statements? Disclaimer, did I say Department of Defense is the one? Okay, there's a disclaimer on Department of Defense. It bubbles up into a what? Into disclaimer on the consolidated financial statements. Stephanie, you said what? It's a secret? Who said it's a secret?
It's confidential.
It's confidential?
Classified.
National security, classified? That's what your patriotic heart would want you to believe, okay? The part of you that wants to sleep well at night. But that's not the reason. Okay, the reason is the Department of Defense is not good at keeping track of their assets. Okay? They're good at blowing up the assets of other people, but they're not so good at what? Keeping track of their own assets. So as a result, the audit of Department of Defense has a disclaimer. That disclaimer bubbles up into a disclaimer on the consolidated. That's one of the reasons, and I'm not going to go through all the reasons because we'll be here all night. The other reason that there's a disclaimer on the consolidated financial statements of the federal government is that the balance sheet doesn't balance. There's a $4 trillion plug in order to get the balance sheet to balance. Why did they need a plug to get the balance sheet to balance? reason for you to know that. I thought you were going to say because there's a debt. No, debt shouldn't cause a balance sheet not to balance. The reason that they can't get the balance sheet to balance is that there's 32 agencies that make up the consolidated statements. Each agency uses its own system to prepare the financial statements, and then they try to back the consolidation into the individual systems. Does that work? You know that doesn't work in advanced accounting. When you had to do consolidation, you started from the bottom and went up, didn't you? They start at the top and try to go back down, and it never works. Just like when you try to start at the top and go back down to the individual statements because you thought it was easier to do that, you could never balance at the end. Same thing for the federal government. They can't get the balance sheet to balance. They have to plug about $4 trillion each year to get the balance sheet to balance. As a result, my former office, the GAO, Government Accountability Office, disclaims an opinion on the consolidated financial statements of the federal government. So when you get to these big issues, like you can't balance a balance sheet, you can't get an audit of a subsidiary, now your scope limitations become so extensive you disclaim an opinion. Okay? Now we're going to go through and we're going to take a look at how the reports are going to vary depending on whether we're doing a unmodified or qualified. And we're going to first talk about non-public entities, and then we'll talk about the way the reports look for public entities. Okay? All right. Any question? Okay, good. So let's go ahead and take a look at the unmodified opinion. This is for non-public entities. This is for non-issuers. Non-public, non-issuers are synonymous terms, okay? And when we give an unmodified opinion, we are basically saying that the financial statements are fairly presented in all material respects in accordance with the applicable framework. Applicable framework commonly is going to be US GAAP. It could be IFRS, whatever. It could be some other framework, but we're going to pretty much in this class consider US GAAP. Okay? Okay, good. Now you come over and let's take a look at the report. And the report is going to have an intro paragraph, okay, although we don't call it intro paragraph. But in there, it's an intro, and that it says, we have audited the financial statements of ABC Company. And when we talk about financial statements, that includes what? Balance sheet, the related statement of operations, that's the income statement, right? The changes in stockholders' equity, that's like our statement of retained earnings, our statement of cash flows for the years then ended, and the related notes. Now, there was a time when people thought that the auditor prepared the financial statements. Do we prepare the financial statements? Management prepares the financial statements. So notice that what we do here is we are very careful to delineate the responsibility of the auditor versus management's responsibilities. So we come right out and we say that management is responsible for the fair presentation of the financial statements. Okay? They are also responsible for what? The internal control, right? We always call them out for being responsible for that as well. Now, the auditor's responsibility is to express an opinion on the financial statements based on the audit. Now, notice we call out that we have followed the standards and we're following the AICPA standards, and we consider those to be the standards generally accepted in the United States. Okay? Now, I'm not going to go through all the detail here, but we start to call out what? That we are looking to see that the financial statements are free of material misstatement. That includes what? Looking at significant accounting estimates made by management. And we are going to be doing audit procedures that will, we're going to do what? Assess the risk of material misstatement. We're going to consider the internal control. Okay, does all this sound familiar? Stuff that we've been talking about throughout this audit, throughout this class, although at a high level, right? Okay, described here. Then we say we believe that our audit gives us appropriate evidence for our opinion. I always call that the little orphan sentence, because that little orphan sentence, it's just there by itself, right? Looks at first like, okay, who cares about that sentence? Meanwhile, it starts to become the most important part of our auditor responsibility section of the report, a little orphan one-sentence paragraph there. It starts to become the most important, because what's going to happen as we start to run into issues where we're going to qualify or adverse, that little sentence is going to change. This is the basis for our qualified opinion, and then we start to call out what our qualifications are, etc. So that's actually a pretty important little sentence there, right? Okay, because it trumpets what's coming. Now, in this case, we are going to give our opinion, and we say, in our opinion, the financial statements referred to above are fair in all material respects, and the results of the financial position, that's the balance sheet, result of operations and cash flows, that's the income statement, statement of cash flows, in accordance with generally accepted accounting principles in the United States of America. Okay, U.S. GAAP, in other words. We date the report, we sign it, city and state. We date the report. Remember, we talked last time about dating the report. It is when the auditor what? Thinks that, can't highlight it, but whatever. Is when the auditor thinks that they have sufficient evidence to support their opinion. It's a data report. That's the same date as our management rep letter as well, right? Management rep letter being that final piece of evidence. Question? How important do we think it is that we're independent? We title the report Independent Auditor's Report. Question? Okay, good. I think I forgot. Just to make sure I know who's going to be eligible for the extra credit. Would you mind let me steal a piece of paper and start signing the sheet around? You can just go ahead and set it up for today's class. Question? Okay, good. Now, what happens? We start having problems, and we're going to talk about what? Gaap problems first, and then the gas problems, and see how these reports will get modified depending on whether it's a Gaap issue, a gas issue, etc. Okay? Now, very important, guys. A lot of questions that you'll see on your exam, that you will see in your final, that you'll see when we go through the questions here a little bit later, that when we're talking about Gaap issues, we're deciding between qualified or adverse. If we have gas issues, we're going to be deciding between qualified, same word, or what? Disclaimer. Okay? So when we have Gaap issues, we are trying to decide whether we have qualified or adverse. Okay? Depending on the pervasiveness. Now, let's take a look at how the report that we just looked at will change depending on whether or not we have a qualification or not. So this is comparison to the unmodified opinion, okay, is what we're comparing here to, when we have a qualification due to what? Due to Gaap issues, due to financial statement issues. So what happens? Management's responsibility and auditor's responsibility paragraphs do not change, except for that one little orphan sentence that will say, this is the basis for our qualified opinion. We tell the user that the opinion is qualified. Okay? Now, basis for the qualified opinion now comes, and so now we're going to add a whole new paragraph that we didn't see before that is going to say the reason that we are qualifying the opinion. There was some disclosure that they were supposed to provide that they did not provide. There was some accounting standard that they should have used that they did not use. They misstated an amount of financial statements. Whatever our issue is related to the financial statements, U.S. GAAP says that you're supposed to put a green elephant on every page of the financial statements. They did not put a green elephant on every page of the financial statements, so we're going to qualify our opinion for that reason. My buddy was wearing Air Jordan shoes for his interview. The outfit was fine except for the Air Jordan shoes, and that's what we're going to say in that basis for a qualification. Then what? Then we'll give the qualified paragraph opinion, and we will say what? We will use the words, very important, except for. In our opinion, the financial statements are fairly stated except for the matter that we just told you about up there in that basis for our qualified opinion, whatever that is. Okay? Question? Okay, good. And then you take a look at the example report here, and we don't repeat the management responsibility. The intro paragraph, guys, exactly the same. Management responsibility, audit responsibility, exactly the same, right? Then what? Then we do change, though, that one little orphan paragraph there where we say now instead of the basis for our opinion, we call out that it is going to be what? A qualified opinion, right? And then we give the reasons for our qualified opinion. I don't know. They were supposed to provide some disclosure. They were supposed to account for some leases a certain way. They did not, whatever it is, right? And then in our opinion paragraph, we say, in our opinion, except for whatever it is they did wrong, except for the shoes, everything else is okay. Question? Okay? Okay, good. Now, if things go from bad to worse and it's adverse, intro paragraph, management responsibility paragraph, exactly the same. Then when we get to what? When we get to the auditor's responsibility, exactly the same, except for what? Now we're saying that one little orphan sentence changes, right? This is the basis for our now adverse opinion. And then we say what? Whatever the basis is for the adverse opinion. My buddy was going to wear, what was the problem with the, going to wear a sweat outfit? Whatever it is that's causing us to go to adverse. And notice we don't say except for, we say because of. Much more pointing words, isn't it? So let's see. Except for is what you're saying when you're trying to get your significant other to act differently. Except for the fact that you don't, hug me goodnight at night or whatever, we have a great relationship, right? Because of is what you say when you're breaking up. Because you did this, I never want to see you again. Okay? Much more pointing words there, right? Okay, much more significant. Hey, this is the reason that things are so bad now, right? Okay. Question? Okay, good. Now, yeah, okay. This gives you an example of what the report looks like. Intro paragraph, the same. Management responsibility, the same. Auditor responsibility, the same, except what? That one little orphan paragraph now has the word adverse in there, doesn't it? Okay. Basis for adverse opinion. And we start to go ahead and say all the things they're doing wrong. And we say that what? Because of, where is it? Because of the significance, these financial statements do not present fairly, right? Now, the only thing that I think is a little weird with this little orphan paragraph, if I can probably bother you to keep calling it that. Notice when we're dealing with a qualified opinion, it says basis for our qualified opinion right here. Provide a basis for our qualified opinion. When you have a gas issue, don't you also call it a qualified opinion? So what I find a little bit interesting, a little bit weird here, and maybe they intended it, I don't know. You've got to read the basis for the qualification to know if it's a Gaap or a gas issue, don't you? Which maybe is what they wanted. I feel like it would have been a little more friendly to call it out and say, basis for this gas issue, basis for Gaap issues, the reason we're qualifying. I would have preferred that. They, I guess, wanted you to try to read and figure out the substance of what was going on in that basis for the qualified opinion. So they're pointing to that it's qualified, but they're not telling me if it's Gaap or gas, right? I have to actually read that paragraph to be able to tell if it's Gaap or gas. Question? Okay, good. Let's see what happens when we have gas issues. Again, still called what? Qualified, but now the reason for the qualification is going to be that there was some generally accepted auditing standard that I couldn't follow, right? Okay. Now, they give me examples of scope limitations. This is going to cause my gas issues: inability to observe inventory, confirm receivables, inability to obtain audited financial statements of a consolidated investee. In other words, Department of Defense gets a disclaimer, so I'm going to have to do a disclaimer. Okay, if something like that happens. Okay, etc. Okay, refusal of management to provide a written representation. Do they have to provide a written representation? Remember last time we said, and I said automatically results in a qualified because my auditor judgment crushed the actual facts, which is it will preclude a what? An unmodified opinion. We're either going to have to qualify or disclaim, but I'm thinking we're heading towards what? Disclaimer pretty quickly if they won't allow us to, if they don't sign the management rep letter, they don't let us inquire of the attorney. Remember, we're supposed to do that. I started saying, hey, they won't let you even inquire of the attorney. What the hell's going on? I'm thinking we're more towards a disclaimer at that point on our opinion, but certainly we're not going to be able to give it unqualified, right? Or unmodified in case of the non-public company. Okay, now, when we have scope limitations, it could be because of circumstance or management imposed. Okay, circumstance. And we say, for example, a scope limitation may exist when an auditor was not engaged at the beginning of the year when opening inventory should have been observed. What happens? We're supposed to observe the beginning inventory, aren't we? To see if there's what? Any items that are obsolete, etc. Okay, now when we say observe the beginning inventory, that really means observing what? Last year's ending inventory? Because last year's ending inventory is this year's beginning inventory. Okay, so let's say, for example, we are engaged February 1st. Were we there December 31st / January 1st of this year to be able to observe the inventory? So we weren't able to do that, right? Okay, now, we're going to be issuing an opinion on the 12, so let's say 12/31 year 2 is the year end. We're engaged February 1st, year 2. We were not there, therefore, at what? 12/31 year 1, which is January 1st, year 1's beginning inventory. 12/31 year 1's ending is 1/1 year 2's inventory. Okay? Okay, now what happens? What is the date of the balance sheet? 12/31 year 2. Are we there to observe the inventory at 12/31 year 2? Yes, we are. This will be my auditor. Observing the inventory, right? So we're there to observe the inventory at 12/31 year 2, aren't we? So can we give a clean opinion on the balance sheet? Yeah, we can give an unmodified opinion on the balance sheet because we were there at 12/31 year 2. It's just 12/31 year 1, right? Okay? All right, good. What about the income statement? Income statement is going to report on their what? Cost of goods sold, isn't it? And cost of goods sold is constituted of beginning inventory plus what? Purchases. Gives us goods available for sale. Right, Pay? Minus what? Ending inventory will give us cost of goods sold, won't it? And we're cool with what? We're cool with ending inventory. This is 12/31, year 2. Our problem is what? 1/1, year 2, which is the same as 12/31, year 1. That's before we were engaged as the auditors, right? So what are we going to do? Can we give an unmodified opinion, unmodified opinion on the income statement? No. So we could do what? We could qualify / disclaim, depending on what? Depending on the pervasiveness of that quality. I could qualify or disclaim depending on the pervasiveness of that cost of goods sold item, depending on how significant I think it is. But I'm probably going to qualify or disclaim on my income statement, right? Okay. How about my statement of cash flows? How about my statement of cash flows? Well, statement of cash flows has that annoying what? That annoying indirect method. Do you like the direct method or the indirect method? Why? Why do you like indirect method? It feels easier. Indirect method is born of the balance sheet and the income statement. You prepare the balance sheet, you prepare the income statement, you sit there and you look at your current items, see what the changes were, bam, you almost automatically have the what? Have the indirect method done, at least the operating section. And even if you do the direct method, you still have to provide a reconciliation of net income to cash provided by operations, which is what the indirect method does for the operating section. So at some point you're going to have to show what? Net income reconciled to cash provided by operations. And if I just sat there and what? Qualified disclaimed on the stupid income statement, then that what? Net income number that I'm going to have to show somewhere, even if I use the indirect method, even if I use the direct method, I'm still going to have to show net income. I've already qualified or disclaimed on the income statement, haven't I? So I'll probably do what? I'll probably qualify disclaim on the statement of cash flows, the income statement. How about statement of stockholders' equity? Probably going to have to qualify or disclaim on that because I have that annoying net income number, which I'm going to have beginning balance of retained earnings plus net income. There it is again. So I'll probably do what? Qualify or disclaim on all the statements except the balance sheet. I could what? Give an unmodified opinion. Okay? So that's a scope limitation that comes up here. Caused by circumstance. We weren't engaged at the beginning of the year to observe the inventory, right? End of last year. Now, important takeaway here. Different opinions for different financial statements. I can give a unmodified on the balance sheet while doing what? Qualifying, disclaiming, whatever on the other statements. That's perfectly acceptable. Now, you notice this little note that I put here, that inability to perform a specific procedure is not a scope limitation for the audit that will automatically result in a qualified or adverse. Okay, so I could perform what? Alternative procedures. So can you think of an alternative procedure that I might have been able to apply in this scenario? I'm engaged on what? On February 1st of year 2? That's a month after the start of the year, isn't it? Can I do an alternative procedure? And don't say, yeah, just create a time machine, no problem. Create a time machine, go back to the beginning of the year, you're good, John. So I can't create a time machine, can I?
Maybe make them count the inventory on February 1st, and then just kind of look back to their financials.
Beautiful, excellent, excellent. That's exactly what I was thinking. Make them take the inventory on February 1st, retake it, and then what? Back through only a month's worth of purchases, accounting records, whatever, sales or whatever, and we should be able to do what? Get to the 1/1, and that might be an acceptable procedure, right? Now, what happens if I'm engaged July 1st of year 2? Probably not going to be able to apply an alternative procedure because we're going to be there going through records forever to try to get there, and it's going to be cost prohibitive, right? But if it's just 1 month's worth, okay, we might be able to make that work, right? Particularly month of January, which may not be that busy because maybe they're a retail entity that has a lot of year-end Christmas shopping type stuff that really impacts their operations more than, say, January, right? Whatever. Would be so far? Now, what happens if we say, management, count the inventory, please, at February 1st? And they say, here, we're not going to count the inventory. We already did that. No. No. What do we say to them? We say, well, then can you say qualified opinion? Go ahead, try qualified opinion, because that's what's going to happen to you. Because now we have what? We have a management imposed limitation, and if management will not remove that limitation by helping the situation, by maybe taking the inventory at February 1st in our little example, then we're going to express a what? A qualified or adverse opinion, or disclaimer of opinion because of the scope limitation. And we'll have to communicate that to those charged with governance. We go to the board of directors and tell them, all they had to do was take the inventory again at February 1st, we wouldn't have this problem. Are you going to wait till the end of the engagement to tell those charged with governance that? You're probably alerting them immediately, right? You're maybe even thinking of withdrawing from this engagement if you think that this is what? So significant that you do not even want to be associated with these financial statements, right? Okay? Okay, good. So let's look at how the report looks then when we have a disclaimer. And intro paragraph, we say we were engaged to audit. We don't say we audited. For example, let's say you're engaged to marry someone, and then it turns out the person is an axe murderer. People say, hey, didn't you marry that axe murderer? You say, no. I was engaged. We didn't go through with it because I found out they're an axe murderer or whatever, right? So we don't want people to think that we actually what? Audited this instance. You want to say we audited. We say, hey, we were engaged to audit, right? Okay. Then what happens? Management responsibility the same. Auditor's responsibility paragraph, we're going to change the heck out of that. Our responsibility is to express an opinion, and what? We are not able to express an opinion. Basis for our disclaimer, and then when we have a disclaimer, we use what? We use the more pointing word, not except for, but now what? Because of. Okay, and you take a look, guys, at the disclaimer, and again, we were engaged. We do not express an opinion. What were the reasons for the disclaimer? And there's the because of phrase. Question. I don't know why this is here. I have no idea why I put this slide here. This must have been right about the time I was in need of some more caffeine. I have no idea why this is here. Oh, okay. If the limitation is so bad, we could do what? That's what it was, which I already said. Withdraw from the engagement. I'm just putting that out there, that is another alternative to what? If the problem is so bad, so pervasive, you have the option to withdraw, unless you cannot withdraw by operation of law or regulation. Why would you not be able to withdraw by operation of law or regulation? You guys are on fire tonight. That's exactly what I was thinking, which is the CFO legislation says that GAO, my office, will audit the consolidated financial statements of the federal government. And if we said, well, we're withdrawing from the engagement, then the answer would be, well, you're in violation of the law. Now, I don't know what they do in that case. I guess they come and arrest the Comptroller General of the United States. We always used to have these mandatory reporting dates that we had to report by a certain date on certain things. And so we would be with our hair on fire trying to meet those mandatory reporting dates. But we always used to laugh and say, hey, we want to get rid of the Comptroller General. Let's just all work together to miss that date. I guess they'd come and cuff him and take him away because he's in violation of the law. I don't know exactly what happens if you don't comply with the law to audit, but I guess they don't give you the death penalty or anything. I don't know, because we never missed a reporting date like that. Okay? Okay, good. Good, guys. Okay. All right, let's go ahead and take a look at public companies. Okay, so now when we're auditing public companies, we're going to follow what? Pcaob, Public Company Accounting Oversight Board requirements. And we're going to see that the reports are very similar, but there are some differences that we want to be aware of. Okay, so let's take a look. Notice that we have what? We start with the opinion. So Pcaob is kind of saying, we don't want all of this, hey, how are you? We're here. Get to the point. What is your opinion? Okay, and the opinion paragraph is very much the same. Okay, what was the basis for your opinion? That's sort of like our auditor's responsibility paragraph. Okay, now we do say that the financial statements are the management's responsibility. Our responsibility is to express an opinion, which we kind of did that in the report, but we kind of split it into management's responsibility versus auditor responsibility paragraph. Here we just kind of said, this is what they do, this is what we do, right? And then we start to talk about, we conduct our audits in accordance with, and here, guys, we call out the Pcaob standards. So we don't say standards generally accepted in the United States like we do for the non-public companies. We call out what? This is our, oh, by the way, something very important. This report is called what? Unqualified, which isn't saying anywhere on these slides. It's not unmodified, it's now what? Everybody? Unqualified, which you probably should say somewhere on that slide that it's unqualified. I guess I can write it in there. It's unqualified, not called unmodified. So we're talking about what? We're talking about non-public, it's called unmodified. We're talking about public company, it's called what? Unqualified, which is good, right? This is the happy situation. Okay? But notice, guys, that what? It is very similar. I mean, what we put in here, significant estimates made by management. I mean, that phrase is right out of the non-public company report, right? Okay, so very similar. It's just the way the information is arrayed. And we start with the opinion paragraph, right? The other thing is we have to call out if there were any critical audit issues. What happens? Remember last time we said everything goes up to those charged with governance, and we have to tell them about all the adjustments and stuff we had to make so that they're aware of all the problems? Well, for a public company, they're saying, you know what? Call that stuff out in the audit report as well. So that even if we're dealing with an unqualified opinion, the users of that report will also understand some of the turbulence along the way that was encountered, right? Now, we're not showing what the listing of those were, but there would be a listing of those there. And we talk about the kind of matters that would be listed down there, critical audit matters, whatever they were, things that were communicated to management, those charged with governance. And we would have that discussion there. Even if no critical audit matters were identified, you still have to include that paragraph and say, hey, we didn't have any. Generally, though, they say there will be at least one. So if you don't have one, find one. There'll generally be something. Okay? Okay, good. Now, we could have qualified opinion due to material misstatements. So we're on the what? Gaap side of the chart now again for our public companies. Okay? So when we write our opinion paragraph, we will still, even though it comes at the beginning now, we will still use the words except for. Okay? We will provide an additional paragraph that will go just before the opinion paragraph that will call out the reason for our qualification. Very similar format to what we saw for the non-public companies, right? By the way, it's still called qualified now, isn't it? So it's qualified both for public and non-public when we have problems. We will go ahead and write the basis for our opinion, which is the same that we saw in the basic report, because we still did the same amount of work, just like the auditor's responsibility paragraph was the same when we had a qualification for Gaap issues for the non-public companies. So that's the same. And then when we get to what? When we get to our opinion, well, the opinion's on top, we would use the word except for, right? And then whatever our critical matters were, critical audit matters were. Okay, so here you see the opinion, and the opinion has what? Opinion has the words, where is it? Except for. Basis for the opinion is the same, and of course our critical matters, whatever those were. If we are talking about the qualified opinion now for audit issues, okay, opinion section has the word what? Except for. We have the what? We have the additional paragraph, describes what it was, audit procedures that we weren't able to follow. Okay, but now we say that what? In our basis for our opinion, where we're describing the work we did, except for what we have told you about that we weren't able to perform, everything else we were able to perform. Now it affects the basis for our opinion paragraph, because there were some things we weren't able to do, right? That we'll call out, and then the critical matters would be the same. Okay, so big difference, or a difference worth noting. Big difference. The difference worth noting that if we're talking about what? Audit issues now, and we're qualifying for that reason, it will affect the basis for our opinion paragraph, right? Because there were some procedures that we weren't able to perform. Okay? And then you can see basis for our opinion, there's the words except for somewhere up here. Where's the except for? Right here. Okay. And then in the basis for our opinion, we'll say, hey, except for what we weren't able to do that we told you about earlier, and then everything else is the same, right? And then we give our critical audit matters. Now, if it's a disclaimer, disclaimer is going to change that report significantly, right? So now it's a disclaimer. So we're saying that we were engaged to audit. We weren't able to audit. We disclaim an opinion. Our additional paragraph and all the substantive reasons for the disclaimer, okay, basis for the disclaimer, and it will have the heading basis for disclaimer. We will not talk about our responsibilities to express an opinion because we couldn't do that. And then critical audit matters section will be omitted. I think at that point, not trying to strike that out, I'm trying to underscore that. Try it again. I'm trying to underscore that, I said. Okay, hands of the surgeon here. Okay, we're going to have it, we're going to omit the critical audit matters because I think it's pretty clear we had some pretty critical audit matters at that point that led to disclaimer. Okay, you can see the disclaimer. We were engaged. Basis for the disclaimer. The company did not make a count of the physical inventory. So apparently, auditor felt that inability to count the inventory was significant enough to lead to a disclaimer, right? It doesn't have to be a disclaimer. It could be qualification. Depends on how significant we think that issue is. Okay. Questions?
I have a question. So for the non-issuers, we had 4 different choices, right? We had qualified, this side, and then adverse, and then on the other side we had, on the Gaap side, we had qualified and adverse. So for the public ones, we have, on this side, we have qualified and what?
Let me go back to the grapefruit right here. Same whether it's public or non-public. Only difference is when we have a good situation, the happy face, it's going to be unmodified for a non-public. Unmodified for non-public, unqualified for public. Other than that, everything's exactly the same. However, the format, and much of the wording is the same, it's more the structure that changes how the information is arrayed when you go from non-public to public. For example, the opinion paragraph is right up there at the top. We don't call it management's responsibility, auditor's responsibility anymore. We just say basis for our opinion, and we start calling out our responsibility versus management's responsibility in that paragraph.
So then there's still an adverse for the public.
Yeah.
And then on the Gaap.
Well, yes, except a public company that found themselves here would also be crying because they are no longer going to be listed. If they ended up with an adverse. If they fall down here, they are no longer going to be listed.
Okay, and then so the Gaap would be Pcaob, right? On the Gaap problem.
Gaap is,
For public?
it's the same standards that we're following. What changes is the standards you follow on this side. So the standards are Gaap. Gaap is Gaap.
Oh.
Gaap is Gaap, right? What changes is the standards you follow. Here, we follow the AICPA's Auditing Standards Board standards, and we call those in the report standards generally accepted in the United States of America, auditing standards generally accepted in the United States of America. With the public companies, now we have to follow Public Company Accounting Oversight Board, and they also call it SEC, although as a practical matter, it's really the Pcaob standards. But SEC has the legislative authority to set auditing standards, which they have delegated to the Pcaob for public companies, although frankly, the SEC has also delegated the setting of accounting standards to the FASB. So why do we have to call out the SEC in the audit report for the auditing standards, but we don't call out the SEC for the accounting standards, because we say accounting standards generally accepted in the United States? Because there was doubt to some time as to whether or not the SEC had the authority to set auditing standards. Sarbanes-Oxley came around and said, here, Here you go. You have a little down in the 33-34 Securities Act. Well, Sarbanes-Oxley is going to tell you right now that the SEC has the authority to set the accounting standards, and they're going to delegate that to the creation of Sarbanes-Oxley, the Pcaob. But just to make sure that everyone gets it, they're going to have us put it in the report here as well.
Thank you.
Okay, so over here, we're what? We're saying the standards generally accepted in the United States of America. That's the Auditing Standards Board, AICPA standards. That's for the non-public companies, right? And then when we come over here, and notice we say the standards generally accepted in the United States of America, that's the accounting standards. That's the Gaap. That's the other side. That's the right-hand side of that grapefruit. Okay, and then when we come over to the public companies, where do the public companies go? When we come over to the public companies, now we say that we have what? That we have followed the requirements of the Pcaob. I thought they called out the SEC here too. Maybe not. I thought I saw it somewhere where the SEC got called out too. But definitely the Pcaob. So I may stand corrected on that. I thought I saw one where the SEC got called out.
Regulations of the Securities and Exchange Commission, and the second paragraph.
Where?
Right, go up a little bit. The last sentence of that paragraph above.
Oh, right here. There it was. We follow the Securities Exchange Commission, Pcaob. They call them out, and I think the reason they call them out, because one could argue, well, why is it okay in the opinion paragraph to say that we have followed, in our opinion, the financial statements present for every resolving position in conformity with generally accepted accounting principles of the United States of America? Notice they're calling out the same standards there for the opinion, right? And someone could say, well, why don't they say, and the SEC has blessed those as well, because FASB sets the standard, SEC blesses them. And I think that and here Pcaob writes the standards, SEC blesses them. But I think the reason they're sticking with calling out SEC is I was on an assignment where we were looking at the accounting and auditing standard setting process. And in there, during that audit, we found that the AICPA was saying, no, SEC doesn't have the authority to know. That's not in legislation. We have the authority to set the auditing standards. And so there was some question, well, who has the legislative authority to set auditing standards? And it was sort of questioned. And then when you had all the problems that blew up with Enron and whatnot, Congress came in and said, okay, probably at GAO's recommendation, we'll let you know right here. When we write Sarbanes-Oxley, the law, we're going to tell you the SEC has the authority to set the auditing standards, and they're going to delegate that to the Pcaob. Okay. Any other questions? Okay, good. Now, what happens? Sometimes we issue the unmodified, unqualified report, but there are things that we want to highlight in the auditor's report that we think are important. Okay, now, the report is still unmodified, unqualified. It's still the happy face. Okay, but we're going to add something called, and if it's something that's already disclosed in the financial statements, we will call that an emphasis of matter. If it is something that is not disclosed in the financial statements, but we still think it's important enough to be included in our unmodified report, we will call that an other matters. Okay, but if it's already disclosed in the financial statements, meaning that management presented or disclosed that information in the financial statements, then we will call it an emphasis of matter. Okay, if it's not disclosed, then we're going to call it an other matters, and we'll talk about that here in a second. Okay, now, what are the requirements? We must place the emphasis of matter paragraph immediately after the opinion paragraph. So we're kind of telling you what? The more important thing is that you understand that the opinion is unmodified, unqualified, but we're going to highlight something that's already disclosed in the financial statements by adding this emphasis of matter. It will have the heading, hello, emphasis of matter. Okay, so you take a look, and there are times when emphasis of matter must be used. They're not going to say, hey, auditor, use your judgment. They're saying if you have one of these, you better include that emphasis of matter report at the end of after the opinion paragraph. Okay? For example, if the entity has substantial doubt about its ability to continue as a going concern, and we have to have the words substantial doubt and going concern in that paragraph. You have to have the word substantial doubt and going concern in that emphasis of matter paragraph. Do you think it's important if there's substantial doubt about an entity's ability to continue as a going concern? Is that important? Yes, it is. So they're saying, hey, if you have determined that, you need to put that emphasis of matter paragraph. Okay? Now, is it okay to change your accounting principle from one period to the next? Is that okay? Are we supposed to? You're generally not supposed to, but what? If management, can management do this? Auditor, come over here for a minute. I heard that if we change from completed contract method to percentage of completion method, we'll show a bigger net income. Is that true? Okay, then we want to do it. Can they do that? No, they'd have to come to you and say, you know, we used to use completed contract method under US Gaap. IFRS doesn't allow it. We used to use completed contract method because we didn't really have a good way of estimating how far along our projects were at any point in time. We've developed a new system now. We've got better engineering estimates and stuff, and we think that we can reliably figure out how far along we are in our project. We want to switch to percentage of completion. And they basically have done what? Change to percentage of completion. They account for that as change in accounting principle, in which they would have to restate any previous periods presented. They would have to make a cumulative effect adjustment to the beginning balance of retained earnings of the earliest year presented. They do all that correctly. Then they're in accordance with Gaap, aren't they? Okay? But if we don't mention consistency, then it's assumed that there were no changes. The rule is that if there are changes, now our report has to highlight what those changes are. It's already disclosed in the financial statements because they're having to do all kinds of things, disclose, report a cumulative effect of accounting, change in accounting principle. So we call it what? Emphasis of matter, because we're making sure that anyone who picks up those financial reports now knows that there's no longer consistency, there's been a change in accounting principle. Okay? But they have to be justified in the change. It can't be, I heard that if we change to a different accounting method, we'll have a bigger balance sheet. Is that true? We want a fake balance sheet. No, that's not sufficient reason. It's got to be, well, when we think it's going to be in a better presentation. Whatever, right? Have to make it sound. Okay? Okay, good. If there's a subsequently discovered fact that leads to a change in an audit opinion of a previous year, we would want to emphasize that, right? So we had an opinion that was previous. Now it's changed for some reason. Maybe last year we disclaimed it. Maybe last year we qualified our opinion. We qualified our opinion because there was some information that they didn't account for correctly. Are boards of directors happy when there's a qualified opinion on the financial statements? Boards of directors, they don't like that. They want everything to be nice and unmodified, unqualified. Oh, we need no qualification. So we give a qualification because there was some information they didn't disclose, right? So then the board of directors turns to the CEO, CFO, and they say, you like working here, don't you? And he says, well, yes, as a matter of fact, I do. Then I would fix that issue if I were you. I'd figure it out. So what happens? Hay makes Steven stay all night. to figure out what the problem is. Steven finally figures it out, turns the page, says, okay, here's the issue. Page says, I fixed it. Calls the auditor up and says, I fixed it, right? I come back in and I look and I'm like, okay, yeah, good. That's the way it should have been disclosed, and you gave me the evidence. Can I change my opinion of the previous year? Can I say it was qualified, now it's unmodified? Can I do that? Yeah. I go ahead. Like he just points to, yeah, it's right there on the screen. Now what are you asking me for? I sit there and I can change my opinion. I can say, hey, my opinion was this before, but now it's that because changes have occurred. They fixed it, right? But because financial statements are often comparative statements, I would call out in this year's report, hey, remember what I said last year? I've changed that opinion, and now my opinion is what? Unmodified for both years. But that's perfectly acceptable. Okay? Question? Whatever. Reasons when emphasis of matter is required. Okay, now, you may want to include an emphasis of matter for other reasons. For example, remember we talked about subsequent events? I mean, that's basically what these are, even though they're kind of categorizing them differently than saying other subsequent events. Subsequent event. There was some litigation. There was a settlement afterwards, right? And so we're going to do what? We're going to call that out in our audit report as a significant subsequent event, but we can use auditor judgment about that, right? It's where we want to call that out in our audit report. This slide, gotta do it if you have these. This slide, auditor judgment. What type of opinion are we giving here? Still unmodified, unqualified, right? Other matters means that what? It is something that was not necessarily presented or disclosed in the financial statements, but the auditor determines, well, I'm putting it in there. Now, there are times when it'll be, well, let's take a look at the requirements. Just like for emphasis of matter, it's immediately after the the opinion paragraph, and now it has the heading what? Other matters instead of emphasis of matters. Can you have both?
Yes.
Can you have an other matters and an emphasis of matter? Yes, you can, so we want to distinguish them, right? Okay. Okay, good. Now you come over, and other matters is required for any kind of alerts, subsequent discovered facts. Financial statements were audited by a predecessor auditor, and their report is not reissued. Whatever, I don't care about these. I'm not going to ask you specific reasons for. I might ask you for emphasis of matter, not other matters. At some point the list is like, okay, who cares? I'll have to look it up if I ever run into this. May be necessary for other reasons. Just know that other matters is what? Something that wasn't disclosed? That the auditor decided they wanted in the report, either was required to or what? Decided they wanted the report. But it's not disclosed in the financial statement, so we call it other matters. Okay. Now for issuers, same kind of thing, guys, but now we call it explanatory paragraph. It still goes after the opinion paragraph, but notice it's the same kind of reasons. But for public company, we call it emphasis of matter. Explanatory paragraph rather than emphasis of matter. Okay. Again, if we have a change in accounting principle, we need to call that out, right? Change in accounting estimate that is inseparable from a change in accounting principles will require us to put the emphasis of matter paragraph. Now, the reason I highlight that is if you have a change in accounting estimate, do you have to restate the financial statements? The change in accounting estimate under the Gaap rules? Huh? Good. We don't have to restate the financial statements because what? Statements are full of estimates, aren't they? And so we would sit there and we'd say, well, geez, we'd have to restate the financial statements every year then, every time there was a change in estimate, because as time goes on, we learned that our estimates weren't perfect, right? So the accounting standards say, if you have a change in accounting estimate, you don't have to restate the financial statements, right? But here we say change in accounting estimate that is inseparable from a change in accounting principle now requires that we would include the emphasis of matter, or if we're talking about a public company, explanatory paragraph. Okay, now, what the heck is this? The accounting standards say that we are supposed to come up with an estimate for our uncollectible receivables, right? Is that what the accounting standards say? What happens if we don't have a good basis for determining the collectibility of our receivables? What should we do? Whatever shall we do? If we're sitting there and we don't have a good method for estimating the collectibility of our receivables, yet we're supposed to figure out the uncollectibility, right? What the accounting standards say, well, if that's the case, we're going to require you to use something called the installment method. And with the installment method, as you collect cash, then you will be able to take a certain amount of profit. In fact, we may be so conservative that we won't be able to take any profit under the accounting standards until we have recovered our cost, which is called the cost recovery method. Okay, so with the installment method, gross profit method, every time you get so much cash, you can take some percentage of that as profit. Now let's say time evolves and we get better at estimating our uncollectibility. Time goes by and we evolve, and now we're very good at estimating our uncollectibility. So now we say, rather than use the installment method, we're going to go ahead and use the allowance method. We're going to figure out what our uncollectibility of receivable is and take a bad debt expense for that, right? And credit the allowance and take the full amount of profit and just take the expense. Well, is that a change in estimate or a change in accounting principle? Rooms full of people. Our accountants got into barroom brawls over that. No, it's a change in estimate. No, it's a change in principle. Chairs were being thrown. Okay? FASB came down and said, settle down, you all. If you have a change in accounting principle that is indistinguishable from a change in accounting estimate, treat it as a change in estimate. Therefore, we will not have to restate the financial statements because of change in estimate. But the auditing standard said we don't give a damn. Still treat it as what? As though it were a change in principle, and call it out in your emphasis of matter paragraph. So there's no restatement, but we have to call it out. Okay? Corrections of errors have to be included in the emphasis of matter. Change in reporting entity, correction of material misstatements in previous issued financial statements. All of these things affect consistency and would have to be called out in the emphasis of matter. Okay. You want to take a quick break? We'll come back. We'll do the quiz slash homework for chapter 12, whatever this is. Or you want to do it now and take the break between this chapter and Module A? Well, now that I've teased you with the break, let's go. Okay, so go ahead. We'll take the break. Let's make it 15 minutes, okay? And we'll come back. We'll go through the quiz, and then we'll take a quick look at the Module A stuff. Okay? All right, guys. Okay. Auditors are required to reference consistency in their report when there are changes in accounting principles. In other words, what? you don't have to mention consistency if there haven't been changes, right? It is assumed that we haven't changed the principles if we don't call out a change. If we call out a change, then it's an emphasis of matter that if there is a change, we have to call it out as an emphasis of matter, right? If there have been no changes, we don't say anything about consistency, and it's assumed there have been no changes. Question on that? Okay, good. If financial statements contain a material but not pervasive, I should say, departure from generally accepted accounting principles, the auditor will render a, if it's what? If it's material but not necessarily pervasive, then we start going with qualified, right? Our little grapefruit chart. Which of the following scope limitations would be of most concern to the auditor? The inability to observe inventories? Well, we could perform alternative procedure, couldn't we? Have them count the inventory at a later date, February 1st. Okay. Inability to obtain confirmation of year-end balances. Well, we could do a subsequent collection review, couldn't we? The use of the work of a competent auditor in the audit of group financial statements. When my office, the GAO, audits the consolidated financial statements of the federal government, they don't audit every single agency that makes up the consolidation. They take the work of what? Other auditors and rely on them. They'll look at their opinions and use that work. So it's perfectly fine if you have a group, a consolidated entity, to use the work of other auditors that are maybe auditing one of the subsidiaries, right? Okay, so that's no problem. Management refusal to provide written representations, what's our fallback? If they refuse to, there's no alternative procedure. That's going to be of most concern. We're going to end up with a qualified, and I'm thinking disclaimer. You may even want to withdraw depending on how significant you think that is, right? Number 4, the auditor's report on the entity's financial statements included an additional paragraph discussing a difference of opinion between the auditors and the entity for which the auditor believes an adjustment of the financial statements should be made. The opinion paragraph of the auditor's report will do what? We'll have a qualified opinion and we'll cite what the problem is, except for what we said in our what? Justification for our qualified opinion, whatever, right? But we'll call that out. Auditors will issue an adverse opinion when there's a severe scope limitation. That's going to be disclaimer, isn't it? A violation of generally accepted accounting principles. That's when we issue a qualified or, in this case, adverse, right? Okay. A qualified opinion cannot be rendered because the auditor's lack of independence. That doesn't even make sense. If you lack independence, you will what? Well, I guess I see how it makes sense. You'll disclaim, not adverse, right? Okay. The entity's ability to continue as a going concern, we could issue a what? Unmodified opinion. It has nothing to do with qualification versus adverse. Number 6, when an entity will not permit inquiry of outside legal counsel, the auditor's report will ordinarily contain a what? Heading towards disclaimer of opinion. Definitely not unmodified, unqualified. Qualified opinion referencing a departure from generally accepted accounting principles. No, that's a departure from GAS, isn't it? Not from Gaap. Okay. Unmodified opinion with an additional paragraph. We're not giving them unmodified if they don't let us inquire the attorney. It's going to be qualified or probably what? Disclaimer. Okay. Adverse opinion, that's if there's a significant Gaap problem, not gas problem, like the inability to talk to the attorney is a gas issue, right? Number 7, in which of the following circumstances may an auditor issue the standard unmodified report on the entity's financial statements? The entity changed accounting principles having an immaterial effect? Yes. If there's something that happens that is immaterial, then we're talking what? Anything immaterial automatically results in standard unmodified opinion. Immaterial means who cares? An auditor concludes that there's a material inconsistency in the other information in the annual report to the shareholders containing audited financial statements. If the auditor concludes the financial statements do not require revision, but the entity refuses to revise or eliminate the material inconsistency in the other information, then we will revise the report on the entity's financial statements to include an other matter paragraph describing the inconsistency. We were talking about this at the break. Our opinion covers what? The financial statements, right? But other information might be information that's supplemental to the financial statements. So since our opinion covers the financial statements, we assume the financial statements are okay. But this supplemental information that's right next to the financial statements is materially misstated, then we are required to include as a what? Other matters paragraph the description of that material inconsistency with the information that's not the financials, it's what? It's other information that is very close to the financials. You can't give a qualified opinion on the financials because they're okay. It's the other information that you have a problem with, right? You need to call that out. Okay? In the other matters paragraph. Or if it was a public company, it'd be what? It'd be an explanatory paragraph. When auditors qualify their opinion on an entity's financial statements because of inadequate disclosure, the auditor should describe the nature of the omission in an additional paragraph and modify. And we don't modify the introductory of the auditor's responsibility for a misstatement in Gaap, right? The introductory paragraph is the same. The auditor's responsibility paragraph is the same. Remember, it was just when we start doing what? The little orphan paragraph changes to say, here is our now qualified opinion, and then we give the basis for our qualification, then we give our except for opinion, right? But the auditor's responsibility paragraph and the introductory paragraph stay the same. Number 10, restrictions imposed by an entity prohibited the observation of physical inventory, which accounted for 35% of total assets. Is that a significant amount of the assets? Yeah. Alternative auditing procedures were not feasible. The auditor was able to examine satisfactory evidence of all other items in the financial statements. The auditor would most likely express, and we're going to express a most likely, meaning it's the best answer here. I say qualify or disclaim when that situation happens. Okay, but if you notice, a qualified opinion on the end of these financial statements referring to a departure from Gaap, no, it's a gas issue, isn't it? It's a scope issue. An unmodified opinion, no, we're talking about qualify or disclaim, right? An unmodified opinion, no, we're talking about qualify or disclaim. So the best answer here was what? Disclaim. Number 11, if management fails to provide adequate justification for a change from one accounting principle to the other, we will do what? Qualify or adverse. That's if they don't provide the justification. Remember what I said, they can't come up and say, well, yeah, I wanted a bigger net income. What do I have to do? If that's the case, then they're not justified in the change. We're going to qualify or adverse, right? They need to be justified. They need to say, well, we have better estimates now. Right? Auditors who are reporting on the financial statements that contain a material departure from generally accepted accounting principles should include an additional paragraph and express a qualified or adverse. The grapefruit is answering a good chunk of these questions, isn't it? Number 13, which of the following is an example of a material accounting change that requires recognition in an unmodified opinion on the entity's financial statements? A change in reporting entity was one of those that what? Would affect the consistency? Issue an unmodified opinion? Okay, now what is change in accounting entity? Let me just describe that a little bit. Let's say I have a client that prepares a financial statement, but they don't prepare consolidated financial statements showing statements under one set of ownership. Then all of a sudden they go and the bank says, well, we want to see a consolidated statement that takes the entities that are under this one ownership. So in year 2, they prepare consolidated statements. That's a change in entity. Under year 1, maybe they were just showing company A. In year 2, they consolidate company A and company B. They combine company A and company B. That's considered a change in entity. That is a change in accounting what? Reporting entity that is going to require that we give the consistency paragraph because there's been a change, hasn't there? Now, as a side matter, you would need to restate any previous years to show what they would have looked like had you consolidated them in previous years as well. And I had a student that called me late one night. She said, John, this is your student. I passed the CPA. No, that's great. One person called me at 9:30 at night to tell me I passed the CPA. Okay, what's going on? Well, I have a client that did prepare a consolidation last year. They wanted to prepare a consolidation this year. And I remember you talking about that one time in class. What am I supposed to do with last year? I'm like, well, you have to restate last year to also be consolidated. All I heard was silence on the other end. Probably the person covered the phone as they were weeping. Because they probably just got done with the consolidation for year 2, and they're thinking, I can go home now, and let me check on my future to see what's going on. And I tell them, you got to consolidate last year too. They're probably like, go sleep for me tonight, right? Because they probably had a deadline to get it all done. And they got 1 year done, but you have to restate that previous year. And you have to include in your audit report the call out of consistency, don't you? Because you have had a change from 1 year to the next. They call that change in accounting entity. Change in useful estimates? No. Change in estimate that is indistinguishable from a change in principal, and a change in the life that you're using for an asset is not a change in estimate that is indistinguishable from a change in principal. Management has changed from one generally accepted accounting principle to another, but has not provided a reasonable justification. That is a qualified or adverse. That's the guy sitting out here to get a bigger net income. We're not down with that. Okay? A change from an accounting principle that conforms to Gaap to one that does not, well, here comes can you say qualified or adverse, right? I don't know what they're doing, why they would do this. So you could have kind of eliminated this by the other choices, right? Even we didn't talk about change in entity. Number 14, independent auditors must consider whether the entity has the ability to continue as a going concern. If substantial doubt exists, but disclosure is adequate and no other basis exists for modifying the report, the auditor would give what? Unmodified opinion, but now we've got to add the emphasis of matter paragraph, and by the way, it has to have the words what? Going concern and substantial doubt. Those two phrases have to appear in that paragraph. Number 15, when disclaiming an opinion due a client imposed scope limitation, auditors should describe the nature of the scope limitation in an additional paragraph and modify the what? Disclaiming affected the introductory paragraph. We don't say we audited, we say we were engaged audit. Auditor's responsibility, we say, hey, we weren't able to apply the procedures that we needed in order to render an unmodified opinion, right? So we change the auditor's responsibility, and the opinion paragraph becomes what? Becomes an except for. Right? Number 16, under which of the following circumstances would a disclaimer of opinion not be appropriate? It's if we are on the what? On the right side of the grapefruit. We're on the Gaap issue side of the grapefruit, aren't we? Okay, so are companies required to disclose related party transactions under Gaap? Is it okay for a company to have a related party transaction? Yes, it is. There's no rule against it, but it has to be what? Under Gaap rules, adequately disclosed. And if they do not, that's a Gaap problem, isn't it? These other things are gas issues. They don't let us talk to the attorney, etc., right? Number 17, when audited financial statements are presented in a document containing other information, the auditor should read the other information to make sure it's consistent with what we know to be the facts based on our audit of the financial statements, right? And if we find that it is materially different, then we'll have to modify our report for that. When I say modify it, meaning we will have to add what? Emphasis of matter to the unmodified, unqualified report to talk about, or other matters paragraph to talk about the material inconsistency between what? Between the other information and the audited financial statements, right? Because maybe the audited financial statements are fine. So we issue the unmodified, unqualified opinion, but we got to call out the problem with that other information, right? Number 19, when there's been a change in accounting principle, but the effect of the change on the comparability of the financial statements is not material. If it's not material is the same as saying what? Who cares? You don't have to worry about it. Number 20, when financial statements contain a departure from Gaap, the auditor should explain the unusual circumstances in a separate paragraph and express an opinion that is qualified or adverse. Gaap issue. I guess the last one's the best answer, because someone could say, well, why not qualified? Why not adverse? Because qualified or adverse, depending on the overall materiality and pervasiveness of the Gaap departure, is a better answer. More complete answer, I guess. Okay. So, as usual, my ambition to do 2 chapters in one night is not looking good. So, what we're going to do is let you take a look at the material for Module A on your own, but it will not be on the final. Sound like a deal? Because we're going to rush through it, and you're going to be sitting here going, what? And rather than put ourselves through that, I'll let you take a look at it on your own. We will not have it on the final. So the final now will consist of chapters 10, 11, and 12. Those 3 chapters, 10, 11, and 12. Okay. 10, 11, 12. It will be given on the 20th. Okay. And it will be given not in class. You can take it from home inside of e-learning. And what I'll do is I'll open it up at 12 noon on the 20th, and it will be open until 12:01 on the 21st. So I'll give you a 12-hour window in which time you can take it once you're into it, I'll give you 3 hours to take it, as though we were in class. A little more time, so I'll give you 3 hours. So once you open it within that 12-hour window, you've got 3 hours to complete it. But if you want to take it at 12 noon, and be done at 3 o'clock, so you can start drinking early on the 20th, that's fine, you can do that. However, do not do what some of my students do, which is, well, no, I'm going to go drink before, and I'm going to open it up at 11, and because this is going to be so easy. And then all of a sudden, I'm getting, called, Professor, give me one more chance. Sorry. Okay. Don't do that. Okay, so you've got 3 hours within that 12-hour window to be able to take it from home. Make sure you have a good internet connection. Make sure you're somewhere, don't say, well, since we can take the exam online, I'm going to go kayaking, and then all of a sudden, I can't get my hotspot out here in the middle of the day. Okay, don't do that. So treat it seriously as though you were in here in class taking it. Okay, you've got that time to take it. Do your own work. I have ways of knowing. Don't F with me. I will figure it out. I promise you. And you don't want that. I had a student who got the answers from another student, and I said, you got the answers from another student. Tell me who it was. No, Professor. If you tell me who it was now, I can help you. Okay, it was Devin. He gave me all the answers. So the person you help will throw you under the bus to get themselves out. Okay, so do your own work. You've got 12 hours, 3-hour window. That'll be on the 20th. Stay tuned to e-learning. I'll also try to send an email to everyone letting you know where our next class is going to be. It may be in this room, but if we get a larger group to participate in the presentation that we're going to have on data analytics, then we may need to move it to a bigger room. Okay, we'll see. Or we may do theater style. And here was the other thing I thought, rather than doing the conference style, we'll just have rows if it gets that significant. It'll be a 1, 2, or 3-page paper that you'll have to write, summarizing the key aspects of the person's presentation. Someone from KPMG is coming. It'll be 1 page is worth 5 points, 2 pages is worth 10 points, 3 pages is worth 20 points. How many pages are you going to do? Okay, everyone's going to do 3. Okay, so go ahead and do the 3 pages, get the 20 points. Don't worry about getting too particular on it. I'll be pretty liberal in how I grade that, okay? So a lot of times students say, well, give me a rubric of what you want. Just do a good job, please, okay? Hit some of the high points. 3 pages. Okay, if you're saying, well, I don't have 3 pages based on what she said, then look up some other things, Say, and then I looked up based on the presentation what the D in data analytics stands for, and I found out it was data, and data is whatever, okay, and fill it out appropriately. Use it as an opportunity. This is someone from KPMG who apparently has, accomplished quite a bit in this area. So I'm thinking that if you come with questions and stuff too, you're going to get a lot more out of the presentation and the sheet. And I'm looking forward to having that blow up and even more going forward here at Golden Gate. Okay, guys? All right, guys, it's been a pleasure. I will see you next week, okay? And we'll do the data analytics thing, and then we should be able to go from there, okay? All right. Have a good evening.